Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, I apologise for my voice, it sounds a bit rough at the moment, I know. Still feeling a little rough, I'm down with a cold again unfortunately. Although I am feeling a lot better today than I have the last couple of days. And since I didn't update anything on YouTube last week, I was so busy with the Patreon, getting my dividend calendar and stock rating system ready for release today, February the 1st. This is when patrons will be watching this video. YouTube will have it tomorrow. And also doing my leading indicators, coming to the indicators, lagging indicators video on the US economy. That went out last week as well. And I had live stream problems that I had to sort out software for and blah blah blah. Anyway, one thing led to another and then I got sick into the end of the week, so we didn't get anything out on YouTube. So feeling a bit better today, so I thought we'd approach it with a quick look. I say quick, I could go on forever with this one. A quick look with the SPY, which is our proxy for the S&P 500. We're also going to have a look at the VIX and the PCC as well, but let's just start here first on the daytime frame, looking at the SPY. Okay, so the first thing I want to do is I just want to take off the counts for the moment. I just want to look at three things, super simple things. Then we'll look at some indicators. Then we'll look at some other technical analysis, and then we'll come into the Elliott Wave counts, okay? Because there's a lot of them, and for as long as we remain below certain pivots, there will be several interpretations of the count. So we have recaptured for the moment with the daily close yesterday. After coming back down to test it, if I just zoom in, we broke through the 250-day exponential moving average. Now there's three bodies of three candles here sat right on it. Obviously we've got this downward trend line as well. 1, 2, 3 bodies of three candles, back tested here with this long wick, back tested with the body of this candle, back tested with the body of yesterday's candle, and a strong close, fully a full bar for yesterday's close, an engulfing bullish candle above the 250 exponential moving average. Now we've recaptured it before, but we haven't had quite the same sequence of tests. We've come up, tested it with this wick here, broke it with this wick here, up and straight through it, and then this was a single day down and a single day back through it, the back test on the way back. Okay, this is a more, what's the word, gradual test. 1, 2, 3, 4, 5 downward trend and testing this major daily moving exponential moving average. 1, 2, 3 back tests as well. So this looks considerably better from a bullish perspective. We've broken that downward trend line, okay, which has been with us for quite some time. I've actually adjusted it to be more bearish, where I've taken this high and this high. I haven't chopped any of this high out to accommodate this one. I could move it even further if I wanted to give the bears the maximum benefit of the doubt that this is still a trend line, and move it to the extreme reading we had on this day, and we're still back testing it and we're still above it. But I feel that wick to wick, as this was pretty much a standout event relative to the previous highs, makes the most sense. We can see that all moving averages are now pointing upwards. The 250, well, that isn't yet, but it's flattening out after continuing downwards. It's starting to flatten. The 10 is about to cross through it. The 20 is not far behind. The 60 is trading up behind that, and all three of those are pointing upwards. Now we have broken out above the 250 before, but we've only got one once we're in a bear market. So once we get that 60 crossing through the 250, we break the prior trend. So let's just take an example of that. So we break the prior trend and we have our first swing low. So swing low and then a retrace, counter trend move, swing high. This is the first shorting opportunity of a bear market after breaking trend. Okay, in an ideal world, the first move up and back, breaking trend nearest the low of it is the first opportunity in a new bull market. Okay, now we have, because of the way this correction has unfolded, we haven't had a nice clean zigzag down in one move. We've had a pretty convoluted, expansive at times kind of correction, you know, and it's left A bit of a conical kind of shape, which had us thinking for a while that it could be an expanding leading diagonal. We're getting to a point now where if this pivot gets taken out, that becomes highly unlikely. But anyway, I digress. We've got our moving averages pointing upwards. We have gone through the 250 once before with just a 10 before rolling back over. We've come as we came down and tested the 250 with our moving averages before. We bounced off of it before capitulating. So this could be early signs of a bottom here in October. So I've been saying for a while now, several weeks, that while below this trend line and while below this pivot and this trend line, the best technical setup in the short term was to be short. With that trend line breaking and a retracement of well over 50 to 61.8% excuse me, of that pivot, that makes that far less likely. Now, doesn't make it impossible, it's just less likely. Okay, so let me show you what I mean. Sorry if this is going to take longer than I was planning, but it's just one of those things where there's multiple things to discuss. So we have, let's come into line, what looks like 5. 1, 2, 3, 4, 5 down here. So 5 is either the end of something or it's the start of something. Now when we look at, actually it's a 5 from here, so we'd have to come down to a smaller time frame. Hourly, yeah, hourly shows it 1, 2, 3, 4, 5. Okay, on the line chart we've already broken that pivot, but we're going to use the candlestick chart because of that outlier day, that open though where we opened above the trend line then got rejected. And we can see here that there is 1, 2, 3, 4, 5, arguably 5 down. Now we've retraced through the 50, which is the blue line here, through the golden ratio. We did tap it, the golden zone, 61.865, and we've moved higher. When a retracement after 5, right, 1, 2, 3, 4, 5, goes beyond the 50 and the 61.8, we've likely removed one of the two scenarios supporting a further move lower. Now, which one's that? That one is A, B, C. Okay, because in this circumstance, B waves tend to be weaker than, not always, but in a zigzag, they tend to be weaker and retrace less than a wave 2 does. So if we go 1, 2, 2 tends to be deeper. Now, while we've got two scenarios in favour of going lower, we've got A, then B, then C, 1, then 2, then 3. Now we have basically, I would argue, have reduced one of those possibilities down to just it's 1 into 2. And it's gone very deep. Now, wave 2s can be deep, okay, but we went through at our peak the 89% retracement. We retraced basically more than 90% of the move into another pivot here, which is still within the upward trend. Now, if we break this even minor pivot here, the likelihood of this still being a 2 is extremely unlikely. Okay, it's becoming very unlikely at that point. So the idea of saying 1 into 2 is not impossible. I have seen examples of 95, 97, 99% retracements in a 2, but they are far less likely than 61.8% or even 78.2%. So it's really all about this pivot. So what I was saying in those prior videos, which if you can feel free to go back and watch, is I found it just a little suspicious that it's just far too easy to keep shorting this resistance line. It's just too easy, and I had a lot of suspicion that it was going to break, and just, you know, my gut was telling me that it just didn't feel right, essentially. I know that's not, I said, like I said in those videos, we don't go on our gut, we go on what we can see, and we moved down from a pivot with 5, which from something which could be interpreted as either 5 or 3, right? And I've seen counts which support both. So once we come up back to resistance to a lower high, we're still in a trend of lower lows and lower highs. We come away from that in 5, we come back. Right, the obvious call here was to short. Okay, and that's exactly what I did. I did it off this initial pivot from this. Whoops, a daisy. Excuse me. I did it from this initial pivot of 5, 1, 2, 3, 4, 5 into 3, and I did it here back to the trend line, and I got stopped. Now, okay, as we came back above it. That second test of the trend line after 5, this was the most likely place for us to sell off, and we didn't sell off. No, like I said, it doesn't mean it's impossible that we won't, it just means it's now become less likely. So an awful lot of words to say very little, that is, isn't it really? So how can I sum it up? Well, now that we've broken this trend, we're looking for a break of this pivot just to get rid of that possibility of 1 into 2. Okay, that just gets rid of that count. It gets rid of A into B as a zigzag, because this is 5 we're saying. It gets rid of A into B, it gets rid of 1 into 2. Right. And it breaks on the shorter time frame everything internal to this pivot and this pivot, because this is all internal to these two pivots here. It breaks the correlation of this being another lower high. Okay, we could still set a lower high below this point, but we've broken the trend, the internal pivot of this being a lower high, and then a lower low, a low, and then another lower low, and then another lower high, and so on and so forth. So that's the minor pivot we're looking to take out to get rid of those problems. The next one we're looking to take out is what I call a major pivot, because this breaks the sequence of lower lows and lower highs from the actual high back in January 22. So lower high, lower low, lower high, lower low, lower high. This might get taken out, but then we've still got this one. Right, if we come back above here, we've broken that sequence. So we've broken the trend line, but we haven't broken the trend, not yet. And there's a big difference between the two. It's easy to say, oh look, we've broken the trend line, so we're done. Yeah, but you've got to break the trend first. This is why we wait for a back test. Going back to what we were talking about here, right? That's the trend line. We break the trend line, okay, of a series of higher lows and lower highs. But then once we get below this point of higher lows, you see, we've now broken the actual trend. At this point we haven't. Okay, you could even argue, if this is a larger move up, you haven't broken it until you break this point here, if you want to be absolutely certain. Then you come back to a lower high and you've definitely broken trend at that point. Okay, so at the moment we're still in a sequence of lower lows and lower highs, and will be until we clear 431 spot 73. You're waffling a bit, Tom, but it's just, unfortunately, it's a waffly subject at the moment, because we're just at this inflection point, we're at this balancing point, and we could go either way, right? So we're just trying to talk it through. Now, when do we want to be bearish, and when do we want to be bullish? We've already spoke about breaking trend, right? So you break trend, you break a trend line, then you actually confirm the break of trend, then you get the first swing low and the first swing back, right, to a lower high. This here is where you go short, right? Because you've broken trend, you set a lower high, and this is now your margin of risk. Now we could look for a smaller pivot to go short here, and then we get a very small margin of risk. That's what we call the STS, standard trade setup, on the Patreon. But this would be your primary pivot. So this here represents your margin of risk if you absolutely ace the entry, which you probably won't. But if you get it off this pivot or this pivot, maybe you get this as a margin of risk instead. Now this opens up a relatively small amount of risk here, and a potential huge downside to you, a huge increase profit for your short position, right? So surely the same logic applies on the way up. Yes, but we have a little advantage in Elliott Wave where we get to play both sides of the field. Yeah, and we can adapt to what we can see in the price action. So we've broken the downward trend, but we haven't broken the trend yet. So in the sense of breaking that trend and taking out this 431 spot 73 pivot, a move to a new high, right, whenever it comes, however it comes, and a move to a new swing low, that will be the smallest margin of risk you have to be long from a major pivot. It won't be the best margin of risk you can get, not by a long way, but you see what I'm saying. That break of trend, that move back above that level, that move back, you're now in the best setup to be long overall on the longer time frame. Now, what do I mean by Elliott Wave giving us an advantage? Well, we know that 5 is the start of something, excuse me, or it's the end of something, right? So we have the luxury of being able to interpret things flexibly. So we can say this is 5. Now if this is 5 and this is 3, rather than this being 5, we can look at this as 1 and we can look at this as 2. And that automatically reduces your level of risk to this area here, if you were to ace it. Now the thing is, you've got one more pivot here, which if you wanted to trade on the smaller time frame, which you could easily have done, this is several days. If you were down on the hour chart, 30-minute chart, you can see 5 and 3 again, and this becomes your margin of risk between your entry and your stop. And then you've got this pivot here as well, which is a larger 5 and 3, and this becomes, and I know it's easy to say in hindsight, but practice doesn't make perfect. Practice just gives you better and better, tighter and tighter entries, never perfect entries. Well, maybe once in a while, but very rarely. But you see my point. We're trading that as 5 and 3. We can get ourselves into a long trade, okay, and we also know that this is potentially 5 and 3 back. So we're looking for a reversal. Now we came to this line here and got a rejection. That was an opportunity to cover our long. Okay, trap any profit we've made in case we do reverse and go short. We get stopped out, and we've now got a profitable trade to the short side. So we played these two pivots internally. You see what I'm saying? We've got this move up, this move back. We played this bit here in between these two pivots, long and short. You don't have to do that. I'm just saying it gives you the option. Now, what if the long trade turns out to be right? Well, we won't come back beyond here. Okay, we will continue higher. In which case our short from here gets stopped out, and now our long's profitable. We eat the loss from our short, but it's okay. We've covered the loss already with our long trade if we wanted to close out and wait for another pivot, or we can just take the loss and go with it. You see? So, what's all this mean? Well, what all this means is, if this is 5 off of the low, and this is 3, then we're saying that that's the bottom in October. That's the low. And I suspected for a while it could be, and I've expressed my suspicion about this, just shorting this resistance line. But if that's the low, then this is 1 and this is 2, and we are going to get 3, 4, 5, likely taking us to new highs. However, this is just going to be 1. Okay, because I'm saying primary degree, and this will be intermediate degree. It could be quite nasty as and when it comes, but it won't retrace this low. Right, and then we move off in a 3 of a 3. Now that could take most of the year just to get that retracement. So essentially we take out this pivot here, we want to get long where we can. Right, so whether we get 1, 2, 3, 4, 5, another smaller 1, 2 within the 1, 2, so this is 1, 2, 1, 2, or maybe we get part of an extension here, we get another opportunity with a retracement above this pivot, we want to be long, because we're still closer to the lows than we are to the highs. Okay, so we're still reducing the overall margin of risk. I know it sounds like a lot of talk, and I'm probably making it sound far more complicated than it actually is. But anyway, let's move on. Right, so let's look at our indicators for a moment. Between the highs here, okay, and the lower highs we've got here, we've actually got some hidden bullish divergence. Right? So we're a little stronger on the right hand side here with these highs on the RSI, even though they're lower than these highs. So this is a little bit more convincing from a strength point of view than the prior highs were. However, overall momentum on the MACD is, you could argue, is dying down somewhat. Now if this is a more bullish count of 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, and we're going into a wave 3 extension, that will reverse and we'll get more momentum increase into a wave 3, and with the RSI we'll go into overbought conditions as well. Right, and then this will be cancelled out. But looking at the histogram here, we're looking a little bit weaker. Okay, and we haven't got the same stronger move in the MACD here relative to this high. We're a little bit weaker, but we're lower high, so that's okay. So momentum's a little less overall. Now the trend in the OBV, the negative accumulation of volume, bearish accumulation of volume, very, very respectful of this trend line, has just broken and back tested just slightly on the day time frame. We're still a long way off saying we're bullish accumulation. We could be accumulating bullish volume, but we haven't started a bullish trend yet. We've got these highs to take out, okay, and then we've broken the sequence of lower lows and lower highs in terms of volume, accumulation of volume over time. So that's something I'm keeping an eye on. A break of that downward trend in the OBV is often supports a reversal having occurred. It's not 100% reliable, but it often supports it. Okay, extreme oversold conditions on the daily time frame, followed by bullish divergence into the lows. That's a very believable low. On the weekly time frame, we got strong bullish divergence between these closes here on the weekly, here on the RSI, and here on the MACD. So this has all the hallmarks of an actual low being in place. Okay, on the weekly time frame, which looks pretty good. Now, off of our first move back to trend and down, this is where you're supposed to get bullish. We were talking about this, right? It's where most people will get bearish, but it's where you're supposed to get bullish. If you don't know this until after the fact, if for all the bullish traders out there who are Elliott Wave traders, you saw that as 5, they saw this as 3 and they went long. Okay, and we got a 50% retracement, 50 to the 61.8. That's the way we look for a wave 1 or a wave 2, and that's where we came. Right, but where did everyone get bearish? PCC bearish spike, right here. The lowest close of that whole bottom here. This is at the absolute low, is where everyone got the most bearish. The options market blew up in the put to call ratio, and then we moved higher. That extreme spike, the biggest spike we've seen in the PCC since the GFC back in 2009, that feels very much like the market rolling over on the bears right there. They get extremely bearish and then it reverses on them. First pivot off of the low. So if that's the low, this is the first swing, high swing, low off of the low, when everyone gets super bearish, that we come back to trend and now we're just going to go down. And we don't, we reverse higher. That fits with the bullish narrative from here, that we're going to go higher. Okay, so we had that occur. Is there anything else I want to talk about while I'm here? No, let's come into the Elliott Wave counts and then we'll look at the PCC and we'll look at the VIX. So, I know I'm coming off as super bullish. I know, but I wouldn't have been going on about breaking this trend line and these pivots for the last few weeks, and how that means we have to be more open-minded, we have to start thinking bullishly, unless I felt it was a possibility. And we're not there yet. You know, we've still got 1 and 2 as a possibility, we've still got A and B and C as a possibility, right? But we're getting close. So bullish count 1. Let's bring up the larger bullish count, the primary top, putting the W, X, Y, X, Z, triple zigzag into a 2 down here, complete. Come down to the 4 hour. Okay, and this is how we get into 1. And then we get an A, B, 1, 2, 3, 4, 5 and a C. Flat pattern. Here. Now you can interpret this as 5, 3, 5 if you come down to a smaller time frame and just say this is an ABC. I'm just trying to choose the most attractive one. Okay, we finished between the 1618 and the 2618. It's quite a long C. So it's not got the best dimensions, but it does expand, so a longer wave C and an expanding flat is tolerable, or quite normal. So the first way of looking at it, I think, is that we've got a leading diag into 1, back to the trend line, into 2, into 1, into 2, into 1, into 2, into 1, into 2, and then we're going to be off 3, 4, 5, 3, 4, 5, and we're just going to race. And this is a bitch. If this was the case, I really don't want this to be the case, because what it means is the limited time we've had to enter the long trade is going to get taken away from us, because we're not going to get any more significant pullbacks, not until we get to that larger wave 1 high. So this is all going to be, if this turns out to be the case, and we've got a lot of stuff coming out this week. You know, we've got jobs number on Friday, we've got the Fed as well, so it could be a very volatile week. And if we do rip up like this, and maybe it's that extension, and everyone's just chasing momentum, aren't they? You know, we see momentum break out, we break trend, everyone piles in and chases momentum, and that doesn't give us Elliott Wave traders looking for retracements a very good opportunity. But it will come later. You'll get 5 up into a larger one, back into a 2 again. Okay, so I hope this isn't the case, because I would really like to get a bit longer here. But either way, I'm not going to chase it. I've already gotten long, I've already gotten short, and be taken out of my short. So let's look at some alternatives. Bullish count 2. So what if the whole move here is shaping up to be a diagonal? Let's come down to the hourly. So there does feel like a diagonal feel to it. Now, if this completes where I've said it's completed, where there's very little room left, then this is 1, and this will now be A, well, maybe 1, 2, 3, 4, 5, A, B, and C down into 2. Okay, it may continue, but if the price now comes back above this high, then it's not this. Okay, because I've counted this as the 3. So what we can do, and I think what we should do here for the moment, is I'm just going to shift everything up a little bit, because I think it would look better now that we've had another couple of days data. I think it would look better if I look at that as A, B, and C. So A, B, C 2, A, B, C 3, 4, and now A, B, C 5, probably with a little throw over, with the limit being all the way up here, so the 5 can come up quite strong and throw over the top of the pattern. So maybe a leading diagonal. This is preferable to the previous structure, because this gives us 1, and then we'll break this upward trend, and we'll come back in 2, and we'll get a better entry chance to be long. Right, there will be obviously a shout from the bears at that point to be bearish, but it's a liquidity trap up here, and it could be. But we've broken, by that point, we've broken well out of the trend line, and we set a higher high. Now we haven't broken the trend yet, so we still have to be cautious, and that's why we'll look for a setup off of there that gives us control over it. So we'll have 1, back into 2, move up, move back again, something like that. That's an opportunity to enter long more safely by minimizing risk again. But like I say, we're still below these pivots, so it could be any number of things at the moment from an Elliott Wave point of view, which makes it very frustrating. So here's another one. While below this pivot and leading with 5, we're assuming, for as long as we're below it, it could be A, B, C. It doesn't seem likely now. This is least likely of all the counts on the shorter term. It would be the best one to have from a bullish perspective, because we get 1, A, B, C, 2, and then we're back to this as our primary pivot, right, and we've got a small margin of risk looking for a move up and a move back to make it even smaller. Okay, I don't think we're going to be that lucky. Okay, because it just doesn't seem like there's any room left to do that. You never know, that might be it. It might be a really deep retracement, A into B, 1 into 2 if you're bearish, and then we get that, and it's the perfect opportunity to short again. It's always possible. Alright, so now let's look at the bearish interpretation. Bearish interpretation is that we're into one final A, B, C, with this is 1 and 2, 3 and 4 and 5. So let's have a look at that. Okay, so this is the best I've been able to make out of it. Looking at 3 wave, I don't need that diagonal. Excuse me. Oh no, sorry, I'm going double diagonal. That's it. So that doesn't make any sense, Tom. It's highly unlikely. Let's just label that WXY and be done with it. Okay. Let's change this to minuet. Excuse me if I keep sniffing and spluttering a little bit. So A down, B back, 1, 2, WXY, and now we're going to rip layer in 3. Okay, and the break of the trend line was a head fake to trap the balls at breakout. Okay, that's why we're talking about not liking the wave 3 extension idea, because we're not breakout traders, we're retracement traders, and it doesn't give us the opportunity. Because breakouts are often liars, and to chase a breakout it's not normally a good idea. You know, so problem with being where we are at the moment. So still, while below this pivot, it could be 1 into 2, just like it could be A into B still. In which case, we are going to roll over before taking out 410 spot 36, surprise everybody, and just rip down lower. It's a less likely scenario, but it's by no means impossible. Okay, finally, after all this noise, let's just grab that and put that in the bearish correction 1. That's better. Finally, we have this idea. Okay, which is this is still 5, and most bears need this to be 5. Okay, most bulls need this to be 5 as well, for that matter. So that's beside the point. But either way, we come back up in A, B, and C, and we don't clear this pivot. We get a very deep retracement for this A, and this is not the B here. This is a subwave A, B, and C to get the B here, and it's A, B, C, down, W, X, excuse me, Y, X, Z, with this being the Z, A, B, C down. I don't like that, to be honest, because it's just so disproportionately bigger than the rest of the correction. But I guess since we've been expanding the correction the whole time, right, each one gets bigger, then this would be the biggest of the 3 zigzags. Right, but this depends on us staying below 431 spot 73. Because we can't retrace back. If this is 5 down and you convince yourself this is 5 down as a bear, therefore this is A, we literally cannot come back above here and go lower. Right, there's no Elliott wave structure that supports that. We can come through it and come back, and then we'll go higher. We will not make another low under that circumstance. So you'd have to be considering something completely different. Not sure what yet. I'm sure there'll be options, but what I'm trying to basically say, in not so many words, is if you want to be bearish, right? Once you break this, you gotta get a little concerned, and once you break this, you gotta be very concerned if you want to be bearish, because you've got nothing on your side anymore. You've broken the downward trend, and you finished it with 5. And you led with potentially 5 off of a low. Now we don't know how this is going to form, but if this ends up going to a 1618, right, then we've got a very strong likelihood that it's 1, 2, 3. At which point we've not got a corrective structure into a B for a larger, or a WX, right? We're looking at an impulse off of a low. So if you're bearish after breaking all of this, you're clutching at straws, and you're fighting the market at that point as well. While we're below this level, we optimistic bulls have got to be a little cautious, got to be a little careful, because you're fighting the market. You're still in a downward trend, and this is the whole world rests. As a trader, I know it sounds very dramatic, but our whole world, in terms of being right or wrong here, having higher probability, lower probability, rests in this gap. Okay, and even then, there's the chance that you're wrong. Okay, so there you go. That's an awful lot of bullshit, isn't it? And an awful lot of waffle. I'm sorry to just be going on and on and on, but it's just one of those things. You know, I've got other accounts here like Grand Flat, Large WXY, and Major Bear, which I'm not even going to cover because they are contingency plans on top of contingency plans. My gut always tells me, after years of trading, and something I talk about on the Patreon quite a lot, is if you see what you think is 5, followed by 3 to 50 or 61.8%, you should always give it the benefit of the doubt of being bullish, at least in the short term, because it could be A, B, C, and then you go lower, but you still got the trade to C leg of it. But in the best case scenario, it's 1, 2, 3. Okay, so we always look for that 5 and 3 retracement. However, it's not always that simple. When you're in a downward trend, you should respect the trend just as you should when you're in an upward trend. When you're looking for that trend to break, we don't just rely on the trend line, we rely on the break of the sequence of lower lows and lower highs, as we do with higher highs and higher lows. So we're just waiting now to see what happens. Do we go 1, 2, 1, 2, 1, 2 and rip? That at least answers the question, doesn't it? Problem solved. You know, do we do a diag and then a deeper retracement? That comes down in 3. Opportunity to be long again, because we're back testing the trend line. I mean, I'm not certain we are, but that's probably what it would look like. Anyway, so far too much chit chat now. I've been going on for goddamn ages. So let's now catch up with the PCC quickly. Okay, so here we are on the PCC. Now, I spoke about how we saw those extreme readings when we look at the actual price data. Highest readings, there's the line chart reading, there's the candlestick reading. Okay, intraday extreme, line chart reading. That's the most extreme we've seen it in a bloody long time. And we've now rolled back with the 60 exponential moving average back towards the 250, coming away from the same level that we've met multiple times before. Also, if we look at bringing a shorter time frame like the 10, we can see how the sequence is not confirmed yet, but we've got a sequence of rising lows. I think that was the same. We're roughly coming up like that. Now we've come back after this very extreme spike. We've come back through the 60, through the 250. We're heading lower, and we can see something similar with the 20 if we just turn off those. We've now broken back down through that. The 20 is heading lower as well. So I always use the 60 and the 250 for a longer time frame views. I want to cancel out all the noise of the daily data and just smooth it out over time. So we've come back to a major level. We've come back to this extreme fear bearishness line, which is some previous highs that we've seen. It's not perfect. We've broken a longer term downward trend that I spoke about. But I'm just looking now for this to just fall through the 250. Because ever since the low in November 21, here, we've been above it. Ever since coming off the extreme complacency and bullishness back here, we had a move up in May 21, a move back into June 21, and then we moved up into October, November. We've stayed above it since. So if we now roll over, with the 250 rolling over and the 60 rolling over as well, then just like once we do it in the past here, and here, and here, it's not perfect, but once we get below that 250 with the 60, we start to trend down. That would be the sign, I think that would be the sign of a very strong bullish phase coming in the market. So you can say while the moving averages is 60 above 250 trending higher towards fear and bearishness, right, we're getting to the point where we're going to reverse eventually. You know, it's the same true as you keep heading down, right? As you get more and more bullish, we've become more and more bearish while the market's selling off. Okay, and we got the most extremely bearish at a swing low before ripping higher. that could well have been the market bottom in terms of sentiment. The price at the bottom actually came earlier in October, but that was the sentiment bottom. Here we don't know for certain, but that could have been it. And that could be all you write. That could be all she wrote for several years, or for at least many months. So waiting to see that happen. Just found that spike very interesting. They're very rare to see spikes quite this extreme. The last one was the GFC. We've had one here in February 2020, March, February 2020. We know why that is. We had one here back in the Fed pivot, Powell pivot, temper tantrum back in 2018, right? But nothing at the same level since the GFC, right? And these are both significant events at the time. This was just extreme bearishness for the sake of it. No, it wasn't coupled with COVID. Wasn't coupled with a sudden shock to the bond market. So you make of that what you will. I'm not saying it's an exact science, but I just think it's interesting that we had those extreme moves. That could have been the bottom of sentiment, so to speak, and now we're going to start getting bullish and complacent again over time. So there's your put the call ratio. Let's now have a look at the VIX. Excuse me. Now this gives me a little bit more hope that there's going to be some kind of pullback to buy into, because we're coming to this long-term support line in the VIX, this trend upwards since the end of 2017. There's just loads of support here, right? So we're coming back towards that. So we can expect some kind of volatility to bounce off of that, just like we've seen multiple times before. And that might be your wave 2 to buy. It could even be the beginning of some gigantic bearish move and everything collapses. But we've got this downward trend line here and rising trend line here. We're getting compressed over time. Now this takes us well out into 2025, and we could just bugger around inside of here for ages. Okay, or we could break one of these levels at some point. If we break this upward trend since 2017, right, that's uber bullish, because that's highly likely to start something like this. Again, a descent of, so we go down, then we go up, then we go down in volatility, then we go up maybe, and then maybe that's what we're going to be viewing in the VIX. This is all speculation, but I'm just saying, you break that upward support line, that can only be bullish. It can only be bullish. So we'll have to wait and see. But we could just quite happily bounce along it like we've been doing. We had a huge rally in this time up until COVID, and underlying volatility was raising the whole time. That could well continue, but if it were to break and volatility were to start declining, underlying volatility would start declining over time, that can only be bullish long term, I would have thought. I'm not saying there can't be events, there's always events, right? Events, dear boy. But generally, if volatility is low, that's good for the bulls. So anyway, there's the VIX. We've looked at the SPY. Now one final thing I want to look at before we go is I just want to bring up an alternative, a different index. We're going to have a quick look at the DAX. Let me show you how different the DAX looks at the moment. Now you could look at the FTSE as well. We're running out of time though, but so we won't today. But the FTSE gives you a similar story. FTSE is just off the all-time highs. The UK market is just off the all-time highs. Now the DAX isn't a long way off the all-time highs either. Okay, we're not far. Oops, should move it up a bit. We are within 8% of the highs. We've broken the downward trend here, the same downward trend which is in the SPY. Completely the same downward trend, right? Here's the low in October. Here's the October low. Look what we've done since. We smashed this trend and moved higher in 5. I'm not sure if it's done. It might not be done yet. It might have a little bit further to go. Why is that? There we go. I think we've got 1, 2, 3, 4, 5, maybe the 5th wave to come in minute wave degree, and then we're going to get a 1, sorry, and then we'll get a 2, right? Proper opportunity in the DAX for buyers. Maybe that's going to happen at the same time. We'll get the SPY break out and then get a retracement to back test trend, just like we did here on a smaller time frame. It's all speculation. I'm just saying, with the FTSE showing an impulsive move off of that October low, and the DAX showing an impulsive move off of that October low, it's very odd that other markets, which you could argue have more exposure to China reopening up than the US, and maybe that's a factor. But either way, they're looking strong. And we got a perfect back test of the 250-day exponential moving average here in the DAX. Here it is. Now, 10 and the 20 and 60 are all above the 250, all aiming higher. Right? And we came up through trend, broke that lower that trend. Here's the major pivot here. That was major resistance, right? Proper resistance. We broke that. We broke that sequence. We back tested the 250 and moved higher. Maybe we're setting up to chase this with the SPY. Okay, I can't be certain. It's just odd that other markets are looking so much stronger now. You've got the dollar to consider, obviously. If the dollar reverses, that's going to hurt and starts climbing again. It's going to hurt these foreign markets. But only temporarily. We have to remember, when we look at the DAX on the day time frame, guys, the dollar marched higher non-stop from 2008 until it reached its peaks recently. And the DAX marched higher. Okay? The S&P marched higher from 2008 and the dollar strengthened over that whole period. So we can't just say strong dollar, bad market, because it's just fucking wrong. Flat out wrong over the long term. Like 15 years of wrong, that thinking would be. Does it create short-term volatility? Hell yes, of course it does. Does sudden spikes higher in the dollar cause pressure on foreign markets? Yes, they do. They cause pressure on domestic markets in the US. But it's only temporary. The two can march higher together and happily have done for many a year. So, let's just keep that in mind. I just wanted to finish on that because it's just an interesting curiosity. So, back to the SPY just for a final moment. So, we've temporarily recaptured the 250-day exponential moving average. We're still below with our moving averages, unlike the DAX, which are now all pointing up and higher, but we've broken trend. So maybe that pivot is going to get taken out the same way. We're going to come down, going to come up, take out that pivot. Maybe we'll hit resistance here for a while, like we did in the DAX, and we'll trundle around. Maybe that's a bunch of 3-4s. 1 2 1 2 1 2 3 4 3 4 3 4. Who knows? And then we'll get that pop into that fifth, which I was talking about right at the start. 1 2 3 4 5. That's 1, and then we get retracement in the 2. Anyway, there you go, guys. I'm going to leave it there. I feel like I've said an awful lot and very little at the same time. We're just at one of those hurry up and wait moments. We're sat around in a hurry up and wait moment. We've got pivots that we haven't broken yet. It could be any number of things, but it's going to get a lot clearer relatively soon. Okay, I hope that's been helpful. All the best, guys. Take care of yourselves. If you're new to the channel, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and as always, a huge thank you to my Patreon subscribers. Your support is greatly appreciated. And if you're interested in more content like this and a whole bunch of educational content such as Elliott Wave education videos, trading videos, monthly updates that isn't available on YouTube, feel free to sign up to the Patreon. There's a link in the description box below. Head over, have a read, and join us. It's the perfect time to do it, to start the month. Take care of yourselves, guys. I'll be back with you as soon as possible. Bye bye.